Well, good morning, Tony Virtue, Virtue and Partners here, and welcome to our regular update. And after the last couple of updates when we were dealing with Brexit and elections, nice to see a little bit of calm on the markets. And indeed, US equity markets hit a new all-time high. We followed, and as have the British market, maybe counterintuitively. So markets up 8-10% over the last few weeks. I guess the question is why? Look, in part, let's get back to fundamentals. If we look at the US, really 10 years of basically zero interest rates. I mean, a minor effort last year. So really, what's the option from equities and the dividends that flow from that? Really cash and, in many ways, the fear of deflation now. Our CPI came out yesterday, and look, we're struggling to hit 1% of genuine CPI a year at the moment. Now, why is that? Well, in part, technology is reducing the cost of buying goods and services. We are getting more and more efficient. What does that really mean? It means you may have less money in your hand, but that money will go further. You'll be able to buy better. There's more knowledge asymmetry, if I can say that. People are more aware of what a product or service should cost. So how does that feed through? Well, in the short term, it means interest rates will almost certainly just stay where they are. In Australia, may even go down at the moment. I've spoken before about the inelasticity of demand, and I think if you drop interest rates below a certain level, it doesn't really stimulate demand that much. If you can't get a home loan at 4% with 5 years fixed, you probably should not be getting a home loan. So I don't know that really would make an awful lot of difference dropping rates at this stage. And the opposite is the case. If interest rates are very, very high, people who can avoid debt would do as well there. So looking forward, we're coming into our earnings season, starts next week, and with our continuous disclosure here, we've had a few sort of pre-warnings, but not many. So I would think that the earnings season should be fairly predictable. Longer term issues remain really growth, and particularly growth in Asia. That's the obvious area where sustainable growth can still be achieved. At the same time, companies are still looking to be more efficient, drop their cost base. The reality is that labour is very, very expensive and capital is cheap. So not a bad time to leverage up a balance sheet if you can do that sensibly. But you've got to manage your cost base very, very carefully, which is double speak for keeping your employee costs down. So looking to the future now, through the earnings season, I would think that at the moment the dividends, which are running at 5.5% across the ASX 200, put a base against the alternative of cash. And providing there's no great disasters, then it should be a reasonably steady time. Obviously, we've got US elections in November, and whenever we do this, is 2 or 3 times a year when markets do get very choppy. But at the moment, quite a lot of stability, so let's just enjoy the peace for as long as it is here. So good investing, and best wishes till next time. Thank you, Tony.